Accounts payable arise when a company receives goods and services, but is only required to pay for them at a later date. It effectively means the company owes the provider of those goods and services money. It is a liability of sorts. So let's jump straight into an example. Tamela Incorporated has received an invoice from its lawyers for services rendered for an amount of $26 million. The invoice states settlement must take place within 30 days of the invoice date. What would the journal entry process be for this invoice? Firstly, there would be a debit to the legal expense account in the income statement of $26 million, and then there would be a credit to the accounts payable in the balance sheet showing that Tamela owes their lawyers $26 million. If you had to see the journal reflected in the T account and GL, you would see a debit of $26 million in the operational expenses T account and a credit of $26 million in the accounts payable account of Tamela. Second example, Tamela Incorporated has received an invoice from its lawyers for services rendered for an amount of $26 million. The invoice states settlement must take place within 30 days of the invoice date. Detail what the journal entry would be on the day the invoice is paid to the law firm 30 days later. So what's the journal when the invoice is actually paid? It would be a debit to the accounts payable in the balance sheet. That would reduce the accounts payable because the amount we owe is now less. And there would be a credit to the bank and cash in the balance sheet because money would be taken out of the bank account to pay the lawyers. If you had to see the journal reflected in the T account and GL, you'd see a debit of $26 million in the accounts payable T account and a credit of $26 million in the bank and cash T account.